whatever you guys want to talk about.
All right, so yep, started recording again. Where do we leave off before the break?
Happiness.
Happiness. Yeah.
Yeah.
So I think for the past hour or so, we've been talking about happiness, long-term happiness, right? Getting fulfillment out of your lives. And I think all of us agree that money is at least an important tool to achieving happiness, right?
Necessary but not sufficient.
Mm-hmm. That's a good way to put it. It is absolutely necessary, but how we use it, how we prioritize it, and how we spend it is very different from person to person, right? But, this is a good way to transition into something that a lot of people have been doing with their money lately, especially investing, right?
Yeah.
Everybody and their kids know when you grow up, you hear like, oh, when you make money, you invest your money to make more money. And it sounded really simple. And maybe it is, but there's a lot of subtleties and nuances and many different ways you can invest your money to make it grow, right? So let's just talk about how each and every one of us are investing our money, since we all have a similar goal of accumulating money and wealth for FIRE or early retirement or financial freedom, whatever. How are we doing it? So Amir, let's I know you must have a lot of
No, come on.
Let's not
guys
call it
can't start with me first. What? It's what?
I said let's not call it wisdom. Jack was like, Amir, you must have a lot of, I think he's going maybe like wisdom, experience. I was like, let's not call it wisdom.
No, well,
I don't think what's going to come out.
Do you guys want the meme version of it, or do you guys want like the serious version of it? Like where it's serious, I'll make it like as I don't know.
Dude,
we want both, to be honest.
I want you to tell me in your own words. Exactly what.
No, really, there's two versions of it, and I don't think we should start with myself, because I don't know. I think I have a lot of stuff to say, and I don't want this to drag to a part 3. So,
okay.
You guys go for it. Go first. Okay, Tony, what do you do? Last time I heard about you have your money in index funds, right, or ETFs, right? Is that still like the same? Pretty much the same.
Yeah. So I never really had much money in ETFs, and that was not a function of me not saving, but it was the function of me not having money, basically.
Right.
And I'm in the position where I don't have a lot of money, going off at the fact that.
Sorry? But I think you are financial literate enough, knowing what is a mutual fund, what is an index fund, and what is an Apple stock, for example, right? A common stock.
Sure. Yeah. So
yeah.
I guess I'll go over briefly my investing journey. Probably began after first year university, maybe. I was reading a lot about the financial crash of 2008, right? That had just happened 2 years earlier. So I think it was on a lot of our minds. And I was just trying to figure out, like, what exactly happened? Why did it happen? What does it mean? And so I started learning about the stock market at that point. I started learning about economics, and I really took a keen interest in what it meant, more on a philosophical level rather than on a practical level. I think I understood it more philosophically and theoretically than I did understand it practically. And I guess at that time, my thought was that this is a zero-sum game, where only really there's a winner and there's a loser. Both people can't win, because when you buy a stock for a discount off someone else, that person necessarily loses and you win, right? And at that point, I thought that this is, evil. This is, just like kind of crazy, bad thing that I didn't want to get involved in. So I learned a lot about it at that time. I probably knew more back then about the theories and stuff than I do now. And I kind of just tucked it away in the back of my head, especially because I was a student, no money coming in anyways, right? Then I started listening to like the Planet Money podcast and Freakonomics podcast after I graduated because I was so interested in economics. And I started learning that, like maybe this isn't all bad because it acts as a market in such a way that, markets do what markets do, which is to reallocate resources. And so it's not necessarily that it's a zero-sum game where someone wins, someone loses, but that the person who wanted that stock more, that the person to whom that stock mattered more, the person who valued that stock more got the stock, whereas the person who didn't value as much, sold it. And so in that way, it becomes a win-win. And also it acts as a way to, I guess, determine prices, right? It's a way to determine prices when you have a central stock exchange, right? And it's just a way that gets, it starts speeding up market efficiency, right? Mm-hmm. And then I started seeing it as, I wouldn't say like the best thing ever, but I started to see that I served a function. And that in trade, it doesn't have to be zero sum. It can be a win-win. And Planet Money had this interesting episode one time when they talked about index funds. And it was about Warren Buffett making a bet with these 5 mutual fund managers, I think, where he said that I will put I think it was like $1 million or $100,000 into an index fund, right? And you guys can use your $1 million to invest it actively however you want. And I'll make a bet that in like 5 years or 10 years, I will do better than you, right? And he outperformed them like every single year, right? And I think that's when I learned about how mutual funds are a scam. That it's really hard to pick stocks, individual stocks. And when you add in the management fee, right, you're losing even more on top of it. And so when I started thinking about, building wealth and like FIRE and stuff, I knew that the better way to go was ETFs and index funds rather than actively managed mutual funds. And I hold that belief still, even though some crazy things have happened in the stock market this year, right? Like a lot of things have sort of not followed the fundamental theories, I guess, right? Like you would have expected that there wouldn't be this big gap between the actual economy and the stock market, which is what happened this year with COVID.
That's right.
But on the other hand, I guess the reason why I don't pick individual stocks as well is because I think it takes up so much time. And at the end of the day, my whole point is to be able to make money to create time. If I'm spending so much time in this process, I am losing out already. And so that's why I think I still lean towards the passive investment sort of strategy.
Okay.
Makes a lot of sense.
Couple things. Yeah. Well, I personally think. All right. Here's where you're wrong, Tony. Let's just be straight up, right? Okay. I don't think why mutual fund sucks is because of actively managing. There's part of it, right? But I think really where you're losing out and just straight up simple is that it's the fee. It's the 2% compound interest. That's what it is. I don't know if you see a graph, but it's if you know what I'm talking about, you will probably look into it and comparing like how much mutual fund fees seems small, but do add up in like a 10-20 year period, right? And it's a lot. It is a lot, and that's why whenever I talk to people, friends or just like hiking people that would just randomly chat, it's like, don't ever touch mutual fund. It's a scam. It's a scam for people that are one too lazy to do it themselves, 2 afraid of doing them themselves, and 3 just don't care, right? I just don't really see the point of mutual fund. And secondly, I slightly disagree is that individual stocks takes too much time. It does if you do it like what Michael does, which is to
the
honestly,
way. The normal way.
See, like
to read up.
well, yeah. I think I really would consider it a normal way, which I don't. We all have our our arguments if it's the correct way or not, but it's to check out financials, go through their earnings, read through their financial reports, and knows the accounting side of it, right? Which I don't get me wrong, I think it's right. You believe in actual profitable companies with good PE ratios. I don't know if you guys, well, Jack knows,
Price
right? But
earning.
yeah, good PE ratios, but I think that formula is long due for it's going to change. It needs to change. Like that model may work 10 years ago, or from the start of the stock market till now, till maybe 10 years ago, but now it doesn't really work anymore because it's just not. I don't know. I just don't feel like it works anymore. Like example of it is
I think
all these different.
go on,
Go ahead.
finish.
I think all these tech companies that really do outperform, people do see the values of it. They don't know. They no longer trust the PB ratio. They don't care about something that's momentary, like currently. They care about the future value, and that's how Apple got there, how Amazon got there, how Facebook got there. Because you know if Elon Musk asked him that to buy out Tesla and he didn't do it because of whatever reason, and now you asked him, you know, would he do it? And he probably say yes because he never know, right? And I think that formula or whatever calculation of P ratio is so outdated, and I think a lot of people are still trading based on that. That's just I don't know. It's a way of doing it if you're okay with slightly beating the indexes or whatever. But I think a lot of people are not okay with that anymore.
What you're describing, that's not being captured by the PE ratio is prospective growth in these companies.
Yeah. Yeah.
It's the possibility that a random small cap company with like a share price of $5 can grow to become the next Facebook or Google. Um, and there's been companies recently that people have jumped aboard the hype train on, right? Like Uber, Lyft, they had kind of subpar IPOs. More recently, you had DoorDash and Airbnb IPO to ridiculous amounts and grow a lot more. These companies are not worth that much money. They're not even worth probably a
Not
fifth of that
currently.
money. But exactly, the people see the potential of them. People see the name recognition. People see the value in a brand that is regularly talked about enough that they think it's worth investing into. Is it the
So yeah, to
correct? It's hard to say. Um,
yeah, to come back to it, does individual stocks takes a lot of time. Depends on what method you choose, right?
I will say
I
that
mean,
so quant traders, algorithmic traders, right? They design algorithms to trade based on certain variables, certain factors, and I will tell you that these algorithms don't look at price to earning ratio. That's definitely true. They're looking at market sentiment on a company. They're reading social media tweets and posts and news outlets and articles to gauge the interest on a stock first of all, right? If it's being mentioned a lot, is it positive, is it negative? And then they're also looking at real-time trade volume to measure the sentiment of the market in real time. So they have the data from both like in the market in real time and from like public opinion, and they can get a pretty accurate picture of when there's a lot of momentum for a stock to blow up, to moon, so to speak, right? We've seen stocks explode in the past year within a few days, like unfathomable levels of growth based on one or two news articles, right? Vaccine news is one. Uh, Zoom, right, became a mainstream name during the pandemic. A lot of these companies, we saw accelerated growth or what's the opposite of growth? Um, mostly growth, but
decline,
decline. Yeah,
stagnation.
yeah.
Yeah.
So um, a lot of it these days is because you have these algorithms trading at the speed of light, like faster than you can react to real time news, and it's creating more momentum. I think first of all, combined with more people investing now more than ever because it's so easy to, right? Previously, I think when everyday people heard the term investing, it seems a little complicated. You have to open up a brokerage, you have to go talk to your bank or whatever. Nowadays, you just
Gotta
download
call somebody.
Yeah, you got to call somebody. Now you download an app on your
Yeah.
phone. The UI is really intuitive. It's easy to use. It's dumbed down essentially.
It makes sense.
Yeah, it's investing.
It's elementary math.
It's gotten to the point where everyday people can get into investing really easily. Elementary math. Yes, yeah.
No, it is. It is. How is it not? Come on.
Yep.
Like anybody that I could be wrong, right? But anybody has access to
Definitely,
a bank account in the United States.
In investing, that's correct. Yeah, absolutely.
Yeah, they could access Robinhood, right?
But yeah, exactly. It's gotten really easy now to invest.
Yeah.
So I think more than ever, this idea of like FOMO is a big part. Momentum is huge now. Like, if a stock is jumping up 100%, 10 years ago, you might hear about it from one or two savvy friends of yours, or maybe at a dinner table, like one of your cousins or uncles is smart with their money, and he's talking about how much money he made from investments. Now you're seeing all your friends post on social media or Twitter or whatever, just constant news about how this company shot up like 1,000%, and they're like, wait, why don't I do this? And it creates even more momentum. And so yeah, I think what I'm trying to say very long-windedly is what Amir's talking about, how PE ratios is an outdated metric. I think this is a huge part of that, is the digitization of, not the digitization, but the widespread
easily accessible. How should I say?
It's become so mainstream that
yeah.
word of mouth and FOMO is actually sufficient enough to create these kind of momentums in swings in a stock price. Is what I'm trying to say. So these things are not really captured in PE ratios.
Yeah, and I'm not saying that PE. Well, I'm going back now, right? Obviously, but PE ratio is good if you're holding long term. You're holding 10, 20, 40 years,
again,
for
the
example,
correct
right?
way to invest.
Is this the correct way? The correct way of investing is no, but it really is. It's the old-fashioned way of it. I see it. Is that you use that as a metric to measure it, but honestly, for us looking to fire, we don't have that long, right? We're not looking to work 20, 30 years and then retire. That's just called normal retirement, right? If we're looking to do this in 5, 10 years,
but the
you gotta
concept
figure
of
some shit out.
4% rule, isn't it to have all that extra cash in like index funds so that you can withdraw from it yearly?
Well, yeah, no, it's like a race, right? You
that,
sprint the first 90 meters.
That 1 million.
You sprint that first 90 meters.
Listen, if I retire next
no,
next year,
it's hard to get there. That's important, right?
Yeah.
No, but okay. Honestly, okay, go ahead.
I was going to say that, yeah, like Jack does bring up a good point. Like if you are doing this in such a way where you're doing kind of more speculative trading, right, where you're looking into prospective value, with FIRE, that seems like that's going to be a responsibility then. Once you hit FIRE, is that you're going to have to spend the time to do this stuff.
We could retire and become an active day trader. And that word sounds like you're gonna be busy, but I mean, practically speaking, you could trade like a couple times a week, and if you're already familiar and live off that.
So I was talking to Jack with the other groups a little bit before, right, and explaining how option trading good for two type of scenarios. And I could be totally wrong, and this is just my understanding of it. Is that the first option is one, you have very little money, preferably saying maybe just giving out a number 2K less, right? Or have a lot of money, 6 figures in your portfolio. And normal people, right, would definitely put that in an index fund, maybe buy some gold on the side, right? Just buy some bonds, just to keep your portfolio diversified. But I don't think that's where the money is anymore. It's going to get you that 5-6%. Don't get me wrong, maybe even more if the stock market is doing well, 10%, right? But you're never getting three-digit percentage returns, right? And those returns are actually a possibility now. It's unheard of maybe 5-6 years ago, right? Getting a three-digit return on a index, right? But now it's possible because they're using different strategies, because more people have access to it, to the stock market, and they're willing to take that risk.
Well, I wouldn't say that it wasn't possible before, but it has become more mainstream, I think, to
Yeah,
trade
it's
different
more
options.
frequent now, I think, right?
I mean,
It's like for me,
let's say it this way: options isn't this like hidden secret that suddenly Wall Street Bets discovered a couple of years ago. Wall Street itself has been trading options, since the beginning of the stock market. And in fact, like most day traders, they utilize options and leverages and derivatives to basically make more money than you have, right? Like squeeze out extra percentages, like you said. It's just all these
yeah,
concepts used to be considered so. I mean, like I said earlier, just the concept of regular investing was already kind of somewhat foreign to a lot of average people, right?
but I can tell you this, Jack. 4 or 5 years ago, options are used to be so cheap, very,
Yeah,
very cheap,
that's true.
because they're used as a leverage, as a hedge,
You're
right?
right. You're right.
Because
Because less people
people
use them.
don't,
The IV wasn't as high, therefore the prices wasn't as high.
yeah,
So that's definitely an aspect of it. You're right. The more action there is, the more potential money there is to be made there. Yeah,
right,
that's definitely true.
right. So yeah, and then I think, what was I going to talk about? Anyways, like for a normal
I think what
person,
you're trying to say is there's an
investing in
opportunity
fire is,
cost.
is the 4% rule. You put in an index fund, you take it out 4% every year, or live off the dividends, right? Um, that's correct, yes. But how do you get to that first initial? For example, let's just put a number on it, 1 million, right? You could save up, be budget really well, or you can have a great job but live not up to your standard of living, I guess, or lifestyle, or I don't know, whatever it's called, and save the $1 million that way. What else? You could be a trust fund kid, get the money from your parents, right? Well, I don't know, there's multiple different ways, but what I'm saying is, don't we all want to get that goal faster, right? And I'm saying, yeah, once I get there, I'm going to utilize all these different safer strategies to get me that 4% return. But while I'm getting there, probably not.
Well, my
I'm going
question
to take more
is,
risk.
are you gonna be able to flip that switch and once you hit that 1 million threshold, or whatever, just be like,
Absolutely.
okay, I'm walking away from
Absolutely.
it. Yeah, because
Yeah.
I think there's
Like
another
I said,
aspect
well,
of.
no. Here's the thing. And then I have this, like, no, I'm not gonna. Maybe I'm not gonna follow it in the future, but like, here's the thing. Yeah, I'm gonna um, diversify really, and then I think real estate is something that a lot of people,
Mhm.
younger generation, don't really get. Is that, dude? That is the safest and most profitable investment choice you could get, and less, with least amount of risk, right?
Mhm.
But obviously, I'm not there yet. I'm not financially wealthy enough to do that yet. But obviously, I think eventually I'm gonna have a portion of my portfolio doing what exactly I do right now, but rest of it is it's spread elsewhere.
Mhm. Yeah.
Right?
Uh, that's a good point. Diversification is probably the key to making wealth.
Yeah,
Period.
and that's how I plan to fire, is that not really having all my money into an index fund and getting that dividend or return. Maybe 20-30% of it is, but real estate, other stuff, I
Mhm.
don't know what it is yet, but whatever is hot, then in the future, I guess.
Yeah.
Does that kind of answer your question, Tony?
I think at that point, that becomes almost like a part-time job that you have to manage, right? If you have to become a landlord, there are
Mm-hmm.
problems with your tenants. They might have issues that you need to fix. And to me, I guess that in a way defeats the purpose of fire, which is trying to be as removed from these I guess, chore-like responsibilities as you could be. Now, before you interrupt me, I'm going to talk about a few other things I think you brought up.
Yeah, go for it.
I think one key thing is you say that this is, that fire is the safe, like that the 4% rule is the safer way. The ETFs and the 4% rule is the safer way. But you can't, but that you can get there faster by doing, I guess, more active trading. Now, I guess my sort of inclination towards that is that doesn't seem right to me. So the reason for that is there are kind of two things. One is the I guess the mean return, and the other one's volatility. To me, risk means more volatility. It doesn't mean higher returns. So in my mind, the average returns ought to be the same between the two methods, right? But it's just that one has higher variance, and therefore you do have small chances of getting really big gains, but also equal small chances of getting really bad gains. And that to me is the bigger risk.
Okay.
I don't think there's anything like a free lunch in the world, right? Where you can just say that this will make me more money.
Can I just maybe shed a light on the other side before I forget? You are viewing it as the gambler's perspective. How you go into a casino, your odds are always there. When you play a blackjack, when you play a roulette, your odds are always going to be the same. Is that true? The probability of you winning is always going to be there, right? You may get lucky and win big on your first try, but eventually, the more you play, eventually the odds evens out. Correct?
I think it's a little bit different. Did you just say that blackjack and roulette has the same probability of winning? I'm not sure about that.
No, I'm not saying that they are the same probability, but they have their own set of probabilities. We're just talking about roulette then.
What Amir
It has a set of probabilities.
Is that there's a skill element involved, and he believes he has
And not necessary skill, right? And I'm not talking about, okay, I'm gonna quit my job and be a day trader the next day and stuff like that, right? And all these skills are gibberish, technical analysis and whatever, believing in a bull market, bear market, they're all bullshit to me, right? But when you keep on gambling, eventually you do lose your money. Is that what you're saying, right? And I agree with that. When you get that 200K, 300K, 500K, your next, you could be lucky enough to get there, but the next, step, you're going to lose it all, right? And getting there, with that strategy is never going to work. And I'm not saying that that's my strategy. I'm saying that why don't you be the casino instead? Right? Don't you be the casino instead, where you let other people gamble and you take in the smallest enough of profit, but it's it's way higher than you were to gamble that money away.
I think you need to explain these concepts first.
Yeah, maybe I think I would do.
You're jumping into an analogy without explaining the original concept.
Maybe I'm hoping that Tony do understand option trading a little bit better, but I guess I'm wrong, right? Maybe Jack, you understand what Tony understands a little bit better.
But okay. Can I try to unpack what you said a little bit?
I guess no. Let me finish this before we go there. Is that for me, using the normal method of achieving FIRE is to save the money, putting it into an index fund, giving a 10% compound interest return, ideally 10% annually, so that I get there faster. Correct? Right? That's what normal people would do. That's what Michael would do, right? I'm not saying he has the wrong strategy. I'm just using him as an example, right? But what if I tell you there is a better strategy out there that gets you 20%? Would you do it? The answer is, of course, yes. Fuck yeah. Right? But not many people knows about it, or maybe it's too complicated for them. But really, because of the popularity of trading stocks, popularity of people seeing what they can get out of it, and hence you're FOMOing into something. It's getting higher and higher, and that's why PS5 is ridiculously priced right now, right? Because of supply and demand. And I'm saying that utilize that demand for the short amount of time, because eventually, this, with my tinfoil hat on, this fucking shit is going to get regulated. I could be wrong.
My question then for you is, how would you know when this is going to come crashing down? And are you going to be ahead of the curve enough to be able to get out and not, buy into it at the wrong time, right? Because essentially you're timing the market based on, in a way, people's sentimentality, like Jack was saying, and people sort of like their emotions, their FOMO-ness, all these new entrants into the market, right? But to me, that is not a sustainable strategy, and the risk inherent in a strategy like this for me is that you have to time it, right? You have to know when to get out, right? Because it might all look good now, but it could also come crashing down any moment.
How do I explain this then? I'm not betting on timing the market. I'm betting on that more and more people do invest in the future.
So again, I think you should just
That's
tell
my
Tony what your investment strategy is. So
it-
this
my investment
casino
strategy
analogy is
is,
pretty cool for a
is
movie, but for understanding what you're trying to get at,
I don't know, like where do I start?
well, okay,
Where do I
so
start, Tony?
okay, let's start with the basics. Okay, what is an
Okay.
option, and how is it different from buying a share in a company?
Well, Tony knows what buying one share of Apple is. You own one out of limited shares of Apple. You hence own a equity or a stake at a physical company that you believe in, right? Option, on the other hand, is a contract. It doesn't mean a thing regarding to it. Well, it does mean a thing on the underlying company. For example, you are buying a contract on Tesla or Apple, Microsoft. These are the names that people know, and less speculators there are, because they move so they don't fluctuate as much, like you have previously mentioned. Oh boy, how do I really summarize this? And Jack, feel free to jump in if I miss anything. A
So,
contract,
sorry,
for example, me and
can I just jump in
go
because
ahead.
I know what an option is. Are you trying to explain to me? Because I know what an option is. I actually had
Okay,
to
good,
in
great.
in my stats course. I actually had to study the Black-Scholes equation. Have you heard of it?
Oh,
No,
I've
Yeah.
heard of
that's
it.
that may be too high level.
Yeah, so when you talk about how this stuff is like, elementary math, I'm remembering the Black-Scholes model and how fucking big of a monster that was to understand.
Yeah, that was.
Well, I don't know. I don't know if it's well, but Robinhood does make it like an elementary math. Does it not?
Yeah. I mean, that is the genius in these apps, is breaking down these complicated
And
trading.
you know what? I definitely buying into the IPO. You know what?
Yeah,
They are coming out this year,
it
and I'll be in it.
directly helps you, right? It directly helps your case. All right, so
Yeah.
let me try to summarize to you what Amir's whole trading philosophy is, right? So as you know, options are a contract that you can exercise to buy or sell shares of a company at a predetermined price, right? So typically, you can think of it an option for like a call option. If you buy a call option on a company, you're bullish on that company. You expect the price to go up, so you're getting in at a lower price. If you're buying a put option, you're expecting the money to go the price to drop, so you're betting on selling the thing at a higher price than it will be. The thing is, you can also sell puts and sell calls, right? So when you do this, the inverse is true. If you sell a call, you're expecting the price to go down, and you're hoping that whoever buys your call is going to end up with lesser value on that contract, and what you collect from him is the premiums on the call, which is the difference of the call price without the underlying movement, right? That's the general gist of it. So in this case, what Amir's saying when he says you want to be the casino is he'll look for companies that have a lot of trading volume activity, right? It's mentioned a lot in news in certain subreddits, and typically when these companies are picked up by the public, people are bullish on them, right? They're hoping to put their money in them and for it to skyrocket, for it to moon, and so
And they're not people like Michael, right?
these
And
are
and then when I say Michael, it's that they do actually do their research and know what they're buying into and investing
these
into.
people just
Their
have
whole,
a little spare money, right, to invest, and they just want somebody who is smarter than them to tell them what to put their money in. And so along
yeah,
comes
because they saw it on
someone
social media.
on Wall Street Bets,
They
and
saw it on social media.
they use big fancy
Yeah,
words and funny analogies, and they write a beautifully well written post about why you should put your money into this company. And to make it easier for you, they'll even tell you the strike date and the expiration date and the strike price of the call to buy, so you don't have to think for yourself, right? And so when this post
uh-huh.
picks up steam on Reddit and gets a lot of upvotes and traction, you can go to that stock in real time and you can see the IV, the implied volatility for that option that's been mentioned in this post, seems to be really high, and that's because people flooded their Robinhood app after they saw the post, and they started buying because they're like, oh my god, I gotta get in on this. This looks legit, right? A lot of times these kind of posts, these kind of trades don't go the way people expect. A lot of times they're just pump and dumps, right? Or a lot of times, people just got really emotional, like you said, attached to a stock, and they want to share their joy with other people, and it just didn't pan out, right? Sometimes it's more malicious. Some people are purposely trying to pump a stock, and they get out, right? And other people who read their post slower are left holding the bag. So all in all, you have this subreddit Wall Street Bets creating these short term, like extremely volatile trades where people are putting their money into an option, or a lot of their money into buying call options of a certain stock, right? So Amir is trying to take advantage of that and play the other side. So he's going to buy this stock, shares of this stock, and he's going to sell call options to other people, and he's betting on these options not fulfilling, not being in the money because, well, people tend to be really risky on Wall Street Bets, so they're gonna buy really out of the money options. Basically, the only chance they'll make money is if it goes up 10-20% in a short amount of time. But if it does do that, then they make a lot of money. We're talking triple digit gains, right? Like Amir said, quadruple digit gains even. So people are enticed by that high risk, kind of lottery ticket kind of style of investing where, don't put on a thought into this. I'm just gonna bet a little bit of money into this. If it hits big, I win big. But if not, fuck it, we'll move on to the next one. So Amir's trying to say that right now there's a lot of opportunity for this because of what we talked about before with word of mouth, FOMO investing, whatever. And so he's trying to take advantage of that by being the supply to that excess demand. Trying to shave a little profit. So Amir, it sounds like what you're saying is this strategy is roughly netting you like double the gains of what it would if you put it into an index fund. So.
Oh, I actually don't ever calculated this. I'm just saying.
Well, you probably should.
Hypothetically.
Whatever you do, and it's like
no, but it's a lot.
3% gains.
Let's just go. No, okay. See, and here's the thing, and here's where the part is that hey, I'm just as a novice trader, as probably you or 99% of people out there, right?
Mm-hmm.
And I'm saying that long term, Michael's strategy is gonna work. Michael's strategy is gonna have me beat in 50 years, but in 5 to 10 years, I'm gonna shut out his returns, right?
Do you think that?
Because honestly, it's going to average out. It's the odds of it, the ratio of it. I'm not the only smart people. There's billions of people out there that's probably going to attempt the same. But there's 10 billion people more out there that is just crazy enough to buy these things, buy in the hype. That's how it is.
How long do you think the strategy will last? Do you think it will actually last 5 to 10 years? I thought that the market will be efficient enough that these kind of loopholes will be closed pretty fast by other people either jumping in to do the same thing as you do, or just investors getting smarter through experience. I have a hard time conceptualizing that this
actually-
would last that long.
I personally don't even think it'll be regulated. This is not like a new thing.
And then
People have been doing this.
yeah, and then
for a
that's
while.
how,
It may be
and
more
that's
profitable
what I was.
right now than maybe before, but it's not something really new or exploitative even, I think.
Yeah, and that's the thing, Tony, and that's what I believe is that once you do it, you just don't stop doing it. Really? No, ask Jack. He asked me this question. It's like, once you start doing that, would you stop? Would you stop, Jack?
Are we talking about options trading? Would I stop
Yeah,
options trading?
it depends on like how much you put in, right? Obviously, but would you ever stop?
Yeah, I think it's for me. I think it would be pretty easy to stop. Like even now, like typically what happens is if work gets busier or stressful, I'll move all my money into shares or like cash. That way, I'm not as enticed to look at the markets on a like daily basis, and
Right.
I have less stress.
Right.
I can
Right.
focus on my work easier, right? Like one understated part of buying options is you definitely become more stressed, right? Like your daily chart is going to look a lot more volatile. It's going to have a lot bigger of a range, and you're probably going to be more distracted by news and more real time stuff. Because when it comes to options, literally minutes could have like a huge difference on your gains depending on when you bought. Timing is really really big. Yeah, so I think I think I'm already in the habit of only doing options when I have the time for it, or like lately my approach has been if I'm doing an options trade, it's gonna be a lot longer term, like several months into the future, and it's like basically I'm still betting on this company to grow, just like I would if I were to buy shares in them. I'm putting my faith in my own judgment and saying, like if it's gonna grow, then option A will net you maybe 50% more gains than option B, right? Just a random number. You will pick option A if you're confident in your judgment in saying this company will grow, right? So it's in a way it's betting on yourself. It's also obviously higher risk, high reward. But yeah, I think one thing that's definitely key that not enough people understand, especially from Wall Street Bets, is you shouldn't use options trading as your entire investment strategy. It should be a supplement, hopefully. It's not a lottery ticket, right? It's an avenue. It's another source of it's another way to invest your money, And smart people, they use options to hedge their existing investments. So that's its original purpose. Maybe we should use it for that too. Just maybe.
Yeah.
Yeah.
But I guess to answer your question, Tony, do I ever see this going away? Yes, absolutely. Because like what Jack said, it does require a lot of time for you to stay on top of like actually pay attention to the news and stuff like that. But because of COVID, it did give a lot of people that. It did give a lot of people time, and they are in front of a computer most of the time because one, they are working in front of a computer. Two, they're probably home, have nothing else to do. Right? Yes, this will eventually go away. But the thing is, once it goes away, I'll see it because it's all measured in supply and demand format. I'm simplifying it, but it is. But hopefully, with that additional leg up, I could be a little bit closer to my goal, right? And that's what I'm hoping. Right? And it's just not, and there's not just strategies of buying stock and selling the contract to yourself, saying that okay, it's going to go high. There's different strategies, and they're not risky as in okay, if you don't hit the strike, your money's gone, right? There's different strategies, but you play it both ways, right? And then I was telling Jack and other people there's the wheel strategy, which is pretty simple if you do understand option trading. You play it both ways. You play it when the stock goes up. You play it when the stock goes down, right? And here's what I notice a lot of times. So I introduced my girlfriend to trading, not trading, but investing per se, last year or something. But here's, it's a no-brainer issue that I notice. It's that she is happy when stock goes up, but and I keep telling her this is not realized gain. You're seeing paper money. this is literally paper money. You don't have this money. And then when the stock goes down, she's sad because she treated it like it's her money, but it's not really. So it goes through this cycle where
But it is
people
also her money.
it is, but like she's not taking
It's
advantage
not,
of the
but
downward
it
trend,
is. Okay.
right? She's not taking advantage of the downward trend. And if you're God, you buy Apple like Warren Buffett 10 years ago, it's going to keep shooting up, just like an upward trend. There's maybe setbacks, there's maybe stagnation, smaller stagnation in between, but eventually, if you zoom out in a bigger graph, 5-year, 10-year, it went up 20%, 20 times, 30 times, right? But I'm saying, why don't you earn money on the downside as well? Because that's all the profit you're missing.
Can you explain to me this concept of making money on the downside too? I'm not quite understanding.
To explain it simply, you know how there's short sellers that bets that the stock goes down, right? There is the same option for short selling as well.
Puts. Okay, and how? So you're talking about the same idea where someone's posting something on WallStreetBets or something like, oh, the stock's gonna go down, everybody buy puts, and then you supply the put. Is that what you're talking about?
I think Amir is just saying, like, if you don't trade options, you don't have the ability to make money in a downward market. But if you do trade options, you can buy puts when you think the overall economy is going down, and on a red day, you can still make money on that.
But what I'm saying is that you don't even buy puts; you sell puts.
Okay, so you're saying you're always the side of theta.
I'm always the fucking casino. Okay?
So
I don't gamble.
Let's also bring up this very important concept when it comes to options. Okay, there's this thing called theta decay, time decay, right? And the value of that is calculated and is baked into the price of the option. So the further out from the expiration date your option is, the more valuable it is because it has more time to hit that price target, right? It has more time, therefore potential for growth either way, right? But that value is calculated and is in the option. That means that every day, if the stock price is staying still, all other factors are the same, and they will never be the same, but let's assume they are, your option contract value is going to decrease every day because you're approaching the expiration, right? So when Amir is playing the side of the seller, he's really making money from theta, right? He's hoping that people buy these options, puts or calls, because they're hoping for the market to go one way or the other, and the market doesn't move fast enough to meet the price of the contract that they've purchased, and theta is decreasing the value of their contract. When they do exercise, if they ever exercise, Amir pays that money, but the difference Amir takes, and that difference is the theta. So there's a term for this, is theta gain. That's for people who have unlocked the path, the tier above buying, a short-term call or put and hoping to hit the lottery. And yeah.
At the very end of the day, Amir is basically betting on the fact that this stock won't go up as much as these other people believe.
Exactly.
Right?
Exactly.
That's essentially how you're making money, Amir. Now, to me, that's still.
Here's the thing. No. That's not only it. Even if it goes up, you have a preset percentage that you're okay with.
You're
of gaining.
Yeah, of losing, right?
Not losing. I'm always winning by selling a cover call. How is it not always winning?
All right. Well, let's say you sell the call for $25, the strike price, and it explodes to $50. You're not winning anymore.
Well, from my perspective, I made money. That's why I'm winning. I don't care about losing because it's not my money. It's paper money.
All right, wait. What do you
it's
mean
about
by
perspective.
You make money? In that trade, how do you make money?
Yeah. No. You're saying that if I hold the stock and then it explodes from 25 to 50, I hence double my money, right? That could be somebody's strategy. It's not my strategy. My strategy, and that's why my strategy.
No. I'm talking about your strategy, which is you're holding shares. Let's say you have 100 shares of this stock, and you bought in at
25, sure.
25. Oh, sure. Let's simplify. You bought it at 25.
Yeah.
And for some reason, you're selling a call at 25. You're selling it in the money call because you like losing your money.
Yeah.
So, and
Yeah.
somebody buys this call and the stock price jumps to $50. They exercise it. You have to sell your shares to them for
at 25.
At 25. That's right. So,
Yeah.
in that case, if you were to sell those shares normally, you would have made double the money. So
Yeah.
you're saying in this case you
That's
don't view that as a loss because you never.
I don't view that as a loss
in the first place.
because I never see them as gains, because I never trusted I would be lucky enough to hit that jackpot, because to me that is a jackpot. Okay, that is winning the lottery, so to speak.
For
but
you,
I am
it's
okay.
like a statistical anomaly. You're saying in the long
Yes,
run,
because
those kind of situations will not happen, and you will be making money overall.
that's why you go to casino. That's why there's so many casinos out there, because the casino always wins. You could be good. You could get lucky and jumps to 100 even, but I'm okay with that. I'm okay this time to just collect that premium of $1.50. I'm okay with that, because next maybe 50 times I'll win that.
Okay.
And guess what? All these numbers. I don't even need to be a math guy to figure this out. All of them are pre-calculated for you. The odds, of course.
The Greeks.
Yes, and because currently there's so much demand of it, the odds are slightly skewed for the seller.
Yep, that's fair.
Right?
The premiums are already high because so many people are buying them.
And if that's the chance, I could, maybe I could probably make the next millionaire. That's not me, but I'm okay with that because I'm in it for the long game.
Well, okay, I think I'm starting to understand this, but I want to kind of try to re-summarize it.
Okay.
I think I'm starting to understand. I just want to restate it to see if I'm getting it right.
Sure.
So the idea, for example, let's say you hold one stock of Tesla, and then you sell a call option.
Let's use measurements of 100 just for easier sake.
Sure. So you mean owning 100 stocks of Tesla?
Yeah.
Okay, so let's say you own 100 stocks of Tesla, and then you want to sell, and let's say they're worth $100 right now, and then you sell a call option for this Tesla, let's say with a maturation date or expiration, I don't even know the term. Let's say in 1 month, right? And you sell it, let's say, at a strike price of $120. Okay, so the breaking even. So $120, and you sell this option, let's say, for $10, right? I can see how you make money either way, but because that $10 comes to you, and you sell this Tesla stock at a price higher than it's currently, so you double dip in a way too, right? You get the money that the person pays you for this option, for this contract, the $10 plus the $20 for the strike price if it goes through. Well, yeah, like if they exercise it, right? And so essentially you're making $30 on this each Tesla stock, right? And let's suppose that it doesn't reach 120, right? Let's say it just reaches, $110, and they decide not to buy it off you, right? Because it's an option, they don't have to buy it off you, right? Then you just make that $10 off selling the call option. So no matter what, you've made money. You cannot lose money this way. You can only lose the opportunity to have made even more money, right? That's what you're saying. Yeah. And so the strategy works.
And you're missing something. You're missing something. And I lose money theoretically if Tesla drops below $90.
Okay.
Make sense?
Wait, why?
Like because he's holding shares of Tesla.
Right.
Tesla at 100,
right.
So if it drops enough that it eats into the premium cost, then you do lose money.
Yeah.
But
so there's one rule,
and that risk already exists when it comes to basic passive investing. So
yeah.
There we go. So there's like I said, there's one rule that I follow is that I only do this strategy on stuff that I know or the stuff that I do really trust that it won't bankrupt.
So you have to basically, yeah, you have to make sure that the stock price doesn't drop, right? Because then theoretically you can lose a lot of money. And in a way, that's the
It's
only way
only
to lose money.
theoretically. That's the only way you can lose money, but you technically don't lose money because once it's at 90, you keep doing it again.
So yeah, okay. So
do
you
it
sold it
until
at 90, but you buy immediately back at 90, and you just repeat the process. Is that what you're saying?
No.
Okay.
So the guy decides not to exercise the contract, hence not buying your stock, right? If it drops at $90 or $85 for ease of calculation, $85. Well, you keep the stock. Now you still have 100 Tesla stocks. You keep going. You sell it at 95. 1 month later.
Yeah. So if the contract expires, then the other party doesn't exercise it. You don't have to sell your shares. So you can essentially, with the same 100 shares, keep selling, in theory, the same contract at different strike prices
until it reaches zero.
Yeah,
if
it expires worthless, you keep doing it and you're collecting money on the premium, right?
But this relies on so many factors, right? Like partly you have the risk of the stock price dropping, which you do compensate by repeating the thing, right? But if the price is dropping, the value on your future ability to sell the options on the call options is also going to go down, right? If the stock keeps on going down, no one's going to fucking buy like the price you can sell the option at also goes down, correct?
Here's where you're wrong. If I were new at this, I would say you're absolutely right. It makes sense that way. But I don't really know how the formula works. But IV tends to go up both ways. If it goes up a lot, IV shoots up. You make more money selling options. If it goes down, IV goes up. You sell a lot. You make more on premiums by selling options. The only way for IV to really drop is for it to just stay stagnant for a very long time, which it's beneficial for you.
Yeah, so I can explain this a little bit.
Yeah, can you explain IV to me? I'm not familiar with that term.
So IV stands for implied volatility. It's another variable baked into the option price, and it generally refers to the level of volatility that the underlying security has, like the stock, the actual stock, right? And how they calculate that is this is not an exact, I don't know the exact formula, but what they do is they look at the range of strike prices on all options for the stock, and the higher the range is, the higher the volatility is. That makes sense, right? That means that the market sentiment on the stock is that it could go really high or really low, right? The higher the range. So therefore, it's more volatile. It also matters how many people are buying these options. You can see how those two are correlated. More people buying options, more different strike prices, higher range, right? So that way, if a stock is going up a lot or down a lot, you can expect people to buy corresponding calls or puts at higher or lower prices, right? So that's going to increase the range and increase the IV of the stock.
Wait, sorry, can you repeat that last sentence?
Like if a stock is suddenly moving up or down, really quickly due to some external news or earnings report, then people will jump on that and they'll buy corresponding options at strike prices, higher or lower depending on which way it's moving. And so that will increase the range itself, right? Just by you're always buying options out of the money typically. I mean, sorry, not always, but a lot of people are doing that because they're trying to hit the jackpots. So that increases the range, which increases the volatility, which drives up the IV. And
by out of money, do you mean that out of the expected range?
Okay, yeah. So when it comes to options,
for example,
okay, so you have $100. You have a share a company.
Okay. The $120 Tesla is out of money because right now Tesla is at $100. So your 120 is out of the money.
No, if you're buying a call, 120 is out of the money. If your call is anywhere between 0 to 100, it's in the money, because if you exercise it, the current stock price is higher than your strike price on your option, right? Therefore, it is profitable to exercise your option. The money you gain is from the actual stock price minus the strike price, right? Whatever difference that is, it is how in the money you are. If the strike price is at 120, the stock price is at 100, and let's say it expires today, if you exercise that contract, you will be losing $20 per share. So no one would exercise those contracts; they would expire worthless. So they're out of the money. So when you buy an option, people who are trying to use options as a way to gain quick money, as a lottery ticket, as a way to bet that the stock will go up, they're gonna buy out of the money options because they're cheaper, right? They're cheaper and there's higher potential for gains. And that's why they lose most of their money most of the time because it requires significant movement in the stock price, which, it may seem like it happens a lot lately due to everything we see on the news, but realistically, it takes a lot to move the share price of a stock, right? A lot of days it's flat or it's up and down, but the net gain or loss is very low, So yeah, that all ties into, I think, Amir's overall strategy. He's betting on people's like impatience, their emotions, their like overconfidence in a stock's ability to grow, and taking advantage of that.
I feel like there's so many moving parts, and I guess in a way I do have the belief in the efficient market hypothesis that all these things will just be calculated out, and eventually they will just kind of be annihilated, like they'll just cancel each other out.
Yes, the winners and losers will be as per se equal. They're just like you said, it's going to be a flow between money, flow between the rich between and then the poor, and then the poor between the rich, right? It's just translation or location of money.
But
you're just taking a smart part of it.
That is actually not what I'm talking about. The efficient market hypothesis is more so, I think, that the market will see a profit-making mechanism, and then enough people will jump into it such that you kind of oversupply it at that point, and they cancel each other out. Another way to think about it, I guess, with probabilities would be that, let's say you're getting really good odds on something, right? Then a lot of people are going to jump into that, and now the price to play that game with those good odds will go up because there's more demand now, right? And then eventually that profit will just get diminished. It's the same thing as like in a competitive market. Let's say you're selling ice cream at a 50% margin. Well, then someone else is going to see that, and they're going to try to undercut you, but then selling at 40% margin, someone else comes in, and eventually equilibrates to a point, that's close to zero, basically, right? Where someone's making money, they're making just enough money to be worth their effort, essentially, right?
The thing is, you're talking about now, as in time doesn't move. And there's something that Jack did talk about earlier. It's called time decay, because we all don't know what's going to happen in the future, and that's why this can't be a really safe strategy. And one, I know that retail investors don't really do it because they don't know they don't know it exists. Second, institutional investors don't really do it is because ultimately it is risky. It is risky because they're a business that they have to run. They have to give their investors, their shareholders, a promised return, or else they might run a risk of losing their business, right? And that's their risk. But for people like us, us retail investors don't know if Tesla is going to be 120 a month from now, right? And for the sellers of it, and guess for the strategy itself, is that I don't care if it's there. I'm just going to sell it to you. And there's people buying it. And as long as there's demand, and as long as time decay and IV and formula doesn't suddenly break down, the calculation is there.
I would have just thought that the prices would have been determined through the market mechanism to be basically even odds.
I think
As in, when you factor everything together into equation, that it comes out to zero, right? Just like this, yeah, this kind of goes back to like everything we learn in stats about this sort of stuff. And I gotta say, it's been a while, so all of this is not super clear to me at this point. But basically, when we calculated returns and stuff, we always gave them an expected return of zero, and then we calculate the variance around it, right? Meaning that in an efficient market, the prices would be determined in such a way that, I would only sell something that's worth it to me, and you would only buy something that's worth it to you, and the expected value there should be zero across in such, I guess, a type of transaction, because we're not necessarily trading much.
So I agree with you, and I think when you ask the question, is this going to die down, or is this strategy going to keep working? My answer is going to be no. Because of COVID and just all the stuff, there's hyperlated, or I guess increase of demand in these things, and that's why I'm taking advantage of it. Like, in short, right? And then I agree with you. Eventually, it's going to work itself out. IV is going to drop back, because regardless of market correct itself or not, people's going to figure it out, and the bid and ask going to tighten up, and she's going to, there's always going to be more people selling if it makes more sense number-wise for them to sell, right? And I agree with you. It's going to get there. But right now, because of all the reasons, people might not know, it's too risky for the bigger guys. And I'm not saying the bigger guy doesn't do it. The bigger guy does it, but to a huge extent that it's not that us can comprehend, right? And us are just there so that we can really just, the big guys could have all the meat, the chicken, the fucking chair. Yeah, you guys seen The Big Short, right? Mm-hmm. Where that guy is like, you can have the cake, you can have the icing, you can have all the stuff. I'm just having the cherry on top. Yeah. That's a good way of putting it. I'm just having the cherry for now.
I think I can see it now. So essentially, the strategy is based off of sort of more uninformed, more ignorant new investors into the market, right? And so then the trade can be lopsided because you understand the market better than
they don't. Yeah.
The same way, basically, if you're a bank and you run a mutual fund, you're skimming this fee off of them. It's because you have an informational advantage that they don't have. And I agree with you. I agree that the efficient market is a theoretical. It's an ideal that is usually not achieved, right? Yeah. So I can see your strategy. I guess for me, the unsettling part is that this depends on you being accurate, having an accurate view of the world, and having an accurate view of the market sentimentality, how other investors think, what they're doing, right? For me, I guess that entails a level of risk I'm not comfortable with, because that is predicting people's behavior. And if there's anything I learned from psychology, and if there's anything I learned from statistics and doing predictive modeling, is that predictions are extremely difficult, especially about people and their behavior.
I totally agree with that, and that's why you do the wheel strategy. Not only doing on the upside, you're doing on the downside as well. Okay, you are. How should I say it? Unless
Amir,
stock,
what if people become smart enough? What if people become smart enough and there's not as much movement anymore, and so now you can't make money going up or down?
And I fail to see that as a possibility, because humans are always going to be greedy.
That's a good point, though, I think. Because, again, this strategy is not a secret thing. People talk about it quite a lot.
I'm not betting on if COVID comes back again. I'm not betting against another 2008. Unless world ends tomorrow and SPY drops to zero, you'll be always making money. Right? Because there's people, young and old, that sees a triple digit gain on social media and they see that starting capital is $100 and they say that, oh shit, that could be me.
Mm-hmm.
Why isn't it me?
I think one thing is that I agree. You'll probably always be making money, for the most part, right? Um, the I guess, but at some point, the equation is going to level out, and it's not going to be that you're not going to make any more money, but that your returns are going to become less than the average movement of the stock market. And I think that will happen a lot sooner, obviously, than you stopping to make money. And so, in a way, your actions are acting as the market corrector, right, for people to get into good behavior, right?
Yeah, I think I do want to say Amir's point of people are greedy. It's a pretty significant point, I would say, uh, and I think that does kind of explain this disconnect we see nowadays with the market and the actual economy, or even individually with so many companies whose share price seems to be way above where they should be based on their current valuation. People are greedy, right? People want to turn a little money into a lot of money, and they want to do it really, really quickly. So again, when I
And then
say
it goes back to what we are talking about previously. It's about people always want to get better stuff. They want the newer phone. They want the best graphics card. Oh, invest in Nvidia, by the way, good company. And and they always want the better stuff, and that's why Western cultures strive in this market, and you know, and that's why Asian market don't, because just fundamentally we think differently,
Asian
right?
markets
And you know
also,
what? Don't get me wrong. And don't get me wrong, people will like it's asking, well, when will people stop be greedy or I guess stop buying options because they're never stop because knowing myself, I always want better things. I want a bigger house, I want a better car, I want a faster phone, right? And that's just how I am. And knowing how I am, because I went well, I guess this really starts the beginning of my option days, understanding myself, then really to inverse myself is what I'm trying to say. Play against myself.
what do you mean by that?
Uh, as in, like, back in March, why are these theta gang taking my money?
Oh, like
You know,
I think, I think he means that he's preying on people that are like him.
from
He's
the
thinking
past.
like the victim.
Like you learn from your
yeah,
mistakes. You're like, why am I losing money?
yeah,
This is why. Okay,
to a theta gang. Yeah,
let me switch
this
to
is
the other
why.
side so that I'm making money
Yeah,
instead from people who used to be like me. Or who
exactly.
is like the old me.
No, it's just that like I just don't enjoy taking that risk anymore because like Jack said, once you have that option, you don't sleep at night. You check all the news media all around the world, right? You're checking, how's the Asian market doing? How's the European market
I
doing?
think one aspect that we haven't talked about, but it's probably kind of significant too, is for a lot of people, um, this is like it's akin to gambling, right? People don't like to
Yeah.
admit it, but when you're investing, you're pretty much just you're betting on a company to do well or poorly, and
Mhm.
it's really easy to get addicted to gambling. It's just we have so many regulations and stigma in place that it makes it difficult for a new person to become exposed to it. That is not the case with investing. Right? It's so easy now to get into investing, and you have all these kids. Like you can actually get a Robinhood account when you're like 12. By the way, there's no age restrictions. You just need a bank account. Yeah, you just need a social security number and a bank account. So you have kids that can
I'm totally
really
buying that.
really easily get into investing, and they think, oh, what I'm doing is making my money, earn money, right? The whole concept of investing, everybody thinks of it as like you're being smart and long term with your money. But that is not what these options plays are. These options plays are
That's
basically
not
throwing
investing.
money into a casino, right? So you have these kids who haven't really been taught, to like control their kind of like gambling urges because it's not really regulated among kids. We can talk about like loot boxes and stuff. That's a whole other topic when it comes to games, right? Like predatory behavior, exploiting gambling, addictions or like nature, right? So stuff like that. I think investing is the new gambling. The modern day gambling. Except it's cool. It's seen as not a degenerate way to throw your money away. It's seen as a savvy way to earn wealth. But that is not the reality of what many people are investing. So again, that
It's like that
helps
Facebook
them here.
effect.
Facebook effect.
Well, yeah, it's like people only sees the best thing out of someone,
Oh yeah,
right?
sure, yeah.
But they don't see that 99% of people that are actually
Right. It's like you said, like
right.
they see somebody made 100K off of starting from like 200, and they're like, that could be me. If you look at their trades, what they did was throw all of their money in to the one type of trade over and over again. So literally flipping a coin and betting that it lands heads like 10 times in a row, right? Anybody could have this kind of streak. But for everybody that does, you have so many more that did not work out that way that they're not posting or bragging about online. So it's what's the term for
And
this?
right now,
Survivorship bias, right? You only hear about success
yeah,
stories, so
yeah,
you think everyone's
yeah. So people are intrigued by it, and that's why it creates that so much demand. And because of that, IV is high. And when IV is high, you sell it so that people could keep gambling away, and hence you make more money
But
on
I will say
just
that
buying
when
regular.
Tony's pointing out like, is this sustainable? How long is this gonna last? People are gonna catch on, and your argument is people won't catch on because people are greedy, right? People are always gonna be looking for their next lottery ticket.
Oh, I'm gonna say yes. That's true, but due to COVID, this has been elevated to a hyper degree,
Sure. People have more time on their
right?
hands. They got a stimulus check. They're
Yeah,
itching to make money, right?
yeah. They decide they think that and this is totally my thinking. As I have a computer, I understand numbers. Maybe not to a calculus degree, but I do
Calculus
understand how it
degree.
works.
That's high school math.
I can make this work.
Yeah. You're right.
I can make this work, and that's the thing, right? And often I find myself trying to prove myself wrong, and by only doing that, and the only way of doing that is to actually do it, and you get burned enough time to realize, okay, wow, I should quit doing this, or you don't, or you just keep doing it,
So
right?
don't you think
But
that's
the more
Tony's
people,
argument? Tony's argument is people are gonna catch on like you and learn from their own mistakes, and they're not gonna stop
yeah,
making these dumb
absolutely,
trades.
absolutely, absolutely, yeah.
So yeah,
But
his argument is what happens
the
when the
first
supply of dumb people run out to sell these contracts to, right?
Well, here's the thing. When the supply of people runs out, hopefully I
You're
do
rich.
have
You're
enough
retired
or buy
already.
enough.
Okay.
Like
Yeah.
I'm not greedy. Like I'm not looking for infinite amount. Like I'm not wanting to be a billionaire,
Yeah.
right? I just want 1 million.
Mm-hmm. Yeah, I mean that's fair. So
Like
a
I
more
have the
seasoned
rest of my life to
opportunity,
turn that.
he's jumping on it.
I have the rest of my life to turn that 1 million to whatever, right? By using normal methods, right? But then hopefully I have more time to do those things
Uh-huh.
the normal method way. But right now, I just don't. I just think that's a waste of time because one, like people our age, we don't have that much money saved up, right? And even if we did, it's not gonna. It's like a drop. It's like a drop in the ocean.
Yeah.
Right? I'm not saying $1 million is not dropping in the ocean. It is still dropping in the ocean, but I'm just saying, it's all about perspectives.
I have, I think, a couple of thoughts. One is Jack already pointed this out, and you already kind of talked about it. Is that you keep on saying like there'll be more people like me, but the very fact that you've changed shows us that society does change, that people do change. So you might have late entrants, but then they'll convert to become people like you, and then you'll need a new scheme to prey on people that are now you again. Yeah, and another thing is this concept of gambling. You guys touched on how options trading is like gambling. And I guess I see like a key difference, but I think it's not being appreciated. I think you guys are saying that it's not being appreciated. Is that if you go to a casino, for example, the odds are already stacked against you. Whereas if in such a way that it's physically stacked against you, like it's not based on human behavior, it's not based on anything else. It's the laws of physics are stacked against you, right? Whereas if you do options trading, or probably a simpler illustration would just be buying shares, right? That has it is not bounded by the laws of physics for the probability in such a way, because the expected value doesn't have to be negative, right? Because there can be growth, right? There's no physical law that says that stocks that you buy on average will go down. In fact, it's probably the opposite, right? That at least that we've seen, right, so far. And I think that's a key difference. And I think it's, like you guys have said, it's not being appreciated by people because they come in with a gambling mindset rather than this more sophisticated, educated, I guess, mindset about what is the function of the market, right? The function of the market is not to gamble. The function of the market, I think, is allocation of resources, right? And price determination as a mechanism for resource allocation. And I think when you see it that way, then your strategy is different than if you see it as a casino, right? Or if you see it as a way to make money by exploiting other people's mental weakness, maybe, right? But I guess my approach to it is I approach it as this is a system for the allocation of resources, right? And I believe that due to human what's it called, ingenuity, right? That there will be progress, that the market will grow. Now that's not 100%, right? Just it's kind of like Amir's approach. It's not 100%, but I think there's more evidence for that than a temporary fad in human behavior. And so that's the way I approach it. I don't think there is anything wrong with the way Amir approaches it when it comes to the concept of making money. I think there probably are moral issues with it, but with the concept of like using this as a tool to make money, I don't think there's anything wrong with it. But on the other hand, I also think about the amount of time you're spending on this, right? And the opportunity cost of that. So I can put my money in and I literally forget about it. That's why I'm not so up to date with these terms anymore, even though at one point I understood them quite well. And at one point I studied some of these mathematical models, right? But in that meantime, while I've not cared about it, my money has still grown. Maybe it didn't grow as much, right? But it still grew. And also I was able to use that time for things that are important to me. And so at the end of the day, I see that as a win, and I see that as enough, because I do believe that the market is efficient enough to cancel out these kind of loopholes, and that these loopholes will be hard to find, they'll be hard to execute, and you're rewarded for that difficulty executing, right? That's why you have more gains than I do, right? But to me, I guess it's difficult, and it's a problem not worth solving for me, personally.
Yeah, and that's totally fair, right? And it's really, yeah, and I think you're absolutely right. And it really comes down to different investment strategies, what your end goal is. And when I talk to people, what they should put their money on, because I have seen people have like 500K, literally a guy I hike with have 500K sitting in a mutual fund, and it saddens me that he does that, right? But he's happy with it because he doesn't have to worry about it. But guess what? He also have 500K, right? But I don't have that 500K, and I have my goals. And what else am I going to spend that money on, right? Especially now it's COVID. I can't really do anything. I can't even carpool to go hiking anymore. So what do I do that time with, right? A lot of things that I enjoy in the past have, become less interesting for myself. So what else is there to do, right? Other than spending time reading and stuff like that, right? But yeah, no, eventually when I do get outside, I'm not going to stay in front of a computer 24/7. I'm not saying that the wheel strategy or my strategy requires that, because selling options does is 10, well, I don't know how many times better than just buying naked options. But you know, then maybe I switch my strategy up. Maybe I sell something that's little with more time, collect that money, or upfront and stuff like that. But it's all really depends on how things shape out now and this short amount of time, I guess.
I think your guys' argument doesn't really boil down to money anymore. It's more about your prioritization of your
Yeah,
time. And
yeah.
also I think a bigger picture thing is what you get fulfillment out of in general. I think Tony's saying that he's fulfilled by like he like stuff like the stock market make like spending more time for like 10-20% extra gains doesn't fulfill Tony in the same way that it might fulfill Amir or maybe me sometimes. Rather, Tony would spend that time like improving other aspects of his life, right? Like reading a book, reading podcasts, news articles, um, and that's equally as valid as getting fulfillment out of um, exploiting these market inefficiencies to get slightly more gains to reach your goal faster, right? I think there's a lot of fulfillment in feeling accomplished and feeling like you outsmarted the general market in some way, right? For me, I definitely get that fulfillment sometimes. So at the end of the day, it's really about what
and
makes
and,
you
and I think
happy. Right?
and I think there's I think Tony, I don't know if you uh I guess the concept of selling options is a lot less involved than buying just a call or a put. You really just do that once a month. You forget about it, right? Because the strategy is there. You're just using it, right? And then you use that time to really do what you enjoy.
I have a
And
question.
it's and don't get me wrong. Go ahead. How much?
How much time did you spend though having to come up with these kind of strategies, right? And how much reading and time went into getting to the point of having enough knowledge, for example, to come up to get to this point, right? I think that kind of also like I'm just not interested enough, I guess, in
Yeah.
trying to look for these marketing efficiencies because for me, right, like if I hit the jackpot, maybe I'll read something and I'll figure it out right away and I can implement right away. But in truth, you probably have to read many strategies before you can come to one that actually works, right? And so that time to me is not time well
It,
spent. And I agree with Jack. I think it comes down to what you value with your time, right? So it's valid no matter what you value, I guess.
and it's hard to quantify the amount of time because if you're naturally into buying stocks, you kind of learn a thing or two, and then if you're buying options, you learn a thing or two, and then you start wondering, okay, what's on the what you're just figuring out, okay, why is things behaving in this way, and then you learn a thing or two, right? It's not necessarily. I don't think I've ever sat down for a long period of time to read a book about option trading. Come on, that's what Wall Street Bet is for. But you know, other than that, that I don't know. I guess there's really, and I totally agree with you. So I'm not gonna uh, say that you're wrong or anything. But like I think I agree with you. This thing's gonna die down. If it's all personal preferences, if you enjoy mutual funds, hey, be it, man. I'm not gonna argue that that 2% fee is gonna kill your return, right? Because that's what they enjoy. I'm gonna let it be, and I'm not gonna strong arm you into something that you don't believe or you don't see it as a value. But on a topic of investing, isn't it the more the better? Because what else are you investing?
It sounds like it's a trade off between your time and potential extra gains,
Yeah, yeah,
basically.
yeah, absolutely, absolutely. But you spend more time working. Like Jack said earlier, gaining more responsibilities just so that you can get paid higher, right? Those are all times there's stress level involved, and you probably are spending less with time with your family because you're more worrying more about a certain project.
Yeah.
Really, for a sense of achievement and that additional income, right? That's really the two things that you're getting out of it. Um, we can argue that if you get, sense of achievement, or if it's morally right or wrong to, just don't fucking dance, right? But
Oh my
but
god, that's the
I
name
think
of the podcast. Don't fucking dance.
but the thing is, like, in terms of extra income, yeah, like, if you have, for example, you have 10 grand in this, you're making the extra 10-15%, it's $1,500. But if you have 100 grand, it's 15 grand, right? 10-15 grand. And at which point does it outweigh your regular job, right? And
Yeah, I
then
can see what you
right, and then at that point, because this is exactly happened to me right now, is that how much time should I be spending at my actual job, and how much should I be spending time on my investments? And I'm not saying just option trading, right? Investments, as in, like, I do buy common stocks too. Don't get me wrong, like fucking Nvidia, great company. But like I'm saying this because it's all a scale, and it tips whichever way, and it's different from person to person. Right?
Yeah, I think it comes down to, you talked about how much time you would spend on your job versus how much time you would do on this, and you measure that by the returns in, the amount of money and I guess the feeling of accomplishment that you can acquire from these activities. And I guess for me, I guess I'm in a lucky position where I think I like what I do, right? I find fulfillment in what I do, and then so therefore that calculation changes a little bit, right? It's not a job I'm desperately trying to get out of, right? And so I think the calculation definitely changes a lot in that situation. And before we start recording, we kind of talked about the idea of, like, if you go into medicine to fire, and how I said that's a terrible idea because of how long you have to spend in school not making money, then working for minimum wage through residency, and having student loans and stuff, right? And for me, I chose that for other reasons too, right? Besides monetary, because monetary, I think it really doesn't make sense. And so I think that's the lucky thing for me. And also, at some point I thought about this, like, if I had enough money to retire, what would I do? And I was like, I'd go to medical school. And then so I was like, okay, well, that cinches it for me, right? Like, this is what I would have done anyways. And yeah, so I can totally see it from your perspective. And I think it's just a shame that there are not more people.
And it's hard. It's hard to find what you really love, and be also making an income out of it. And I think um, that's and I think the few of people that did achieve that is lucky, right? And it's fortunate for people like me and some others that what I really enjoy is not what I wanted to do for my life, right? And that's why I have sense of urgency to get out of it as soon as possible. But on the other hand, if you do make enough money, I'm not saying a lot, right? Enough money to survive and to have a decent life, an average life, and enjoy and love your job. My suggestion for you is, like, hey, you know what? Don't even touch investment, man. Buy what you like, because you should just enjoy life. Buy that newest iPhone, because that's what makes you happy.
Yeah.
It's going to enjoy your quality of life to a better degree. Why even touch investing? Because that, at the end of the day, is just paper money. It's a number on a screen. It's not even worth it. And that's my philosophy, is that, hey, it really depends from people to people, right? And right now, maybe it's fortunate, maybe it's unfortunate that I'm in a situation that I am in now. But I'm glad that this journey took place, because I don't know, I guess I gained more knowledge out of it. Right? So yeah.
Yeah, I think I'm absolutely impressed by what you've done. Like, even thinking back to the older days when you were making money off Diablo botting, I was like, man, Amir is one entrepreneurial spirit, like he
That's
is
true.
finding ways. He's going out there and hustling. He's finding, what I would say are creative solutions, right? That people like me who've been in school for too long just, aren't thinking of anymore.
And I say this, there's thousands path to Rome, right? And just pick one. You don't have to follow my trail. I'm not asking you to. And I mean, there's at the end of the day, it's all become happiness. I mean, money. You say it doesn't buy happiness, but you need money to become happy, right?
Mm-hmm.
Yep.
And adding on to that, I think you were saying like, oh, people who love their jobs and stuff, they should just not touch investments. I'll tell you why I'm still doing this, right? So there are a few reasons. One is it's security. Like if I get disabled, so I've had a lot of health issues in my life. So one thing I'm definitely worried about is if I get disabled, I need something to sustain me, right? Like I have disability insurance and everything, but this is kind of in a way, it's my own insurance policy. Another aspect of it is you hear about doctors making quite a bit of money, right? I guess the problem with that is the way they're making the money has become unsustainable for themselves psychologically. And that's why when I talk about burnout is being talked about like every day in medicine pretty much. Like it's such a big problem. I think man, a survey a few years ago, 9 out of 10 doctors say that they would not recommend the field of medicine to their children or to anyone else to pursue. And they would not do it again, right? Suicide rate within doctors is way higher than the general public. And I think part of the reason is the commercialization of medicine and, some of the market forces in there right now that's driving people to see patients, faster, right? And also they're shouldering a lot of responsibility, but they have to see patients super fast in order to make the money that they thought they'd be making when they went to medical school. And then the medical legal issues, the patient satisfaction issues, like people are not I think there's a trust issue now with doctors, right? All these things play into a very unhappy work environment. And for me, and this is a bit of a struggle right now, I've thought about two different ways. One way, I practice the ideal way from the beginning, where I don't make a lot of money, right? And I see patients the way I think you ought to see patients, which is kind of slower, taking more time, having more breaks and stuff. Right now, I don't even know if that's financially feasible, right? Like if I'm actually just incurring a loss and not even breaking even, because doctors are small business owners. We bill, but we pay salaries to staff, and we have to pay for rent and equipment and everything, right? So I don't even know if I will break even doing that, right? That's one part of it. Another part of it is I wonder, so there's a struggle between doing that right from the start or collecting a bag of money, right? So that I'm financially independent and then doing that. So then I don't have to worry about the financial parts anymore. And that is something I've been thinking about, and I don't think I've come to a solution yet. I think there's arguments for either way, right? I think the argument where you make a lot of money from the beginning and then you work your ideal way is I guess the safer way in a way, right? That you have that insurance policy of your money from the beginning. The other way would be, if nothing bad happens, right? And you can continue doing this forever. And I just don't know yet. Yeah. Yeah. But I guess I just wanted to talk about that struggle that I'm thinking about and I still don't have an answer for.
Well, it all takes time to figure out, and if you figure out now, oh my God, you'd be very well off. But that's why a lot of people doesn't figure out, right? As long as we have that mindset, and you have that mindset of, okay, this is the problem, and I'm trying to solve it. That's the most important step, really, because a lot of people don't even see the problem. But right, like in terms of just investment, getting back to topic, is that there isn't the right strategy. The strategy depends from person to person, and I would never tell my girlfriend to do what I do because that's just not, I don't know, feasible because I am not her, right? I don't understand how she operates mentally, and yeah.
Yeah, I want to add that like Amir's strategy of exploiting theta to get consistent, reliable gains, it's not like a secret trade tool that he spent years discovering. It's actually just one of many investment strategies that people use. It's mentioned all the time in investment forums. The reason why it's not as popular is entirely because people are greedy, and if you do this option, you won't see those big, huge 100+% gains. You'll see consistent, reliable, steady gains, but that's boring, right? Nobody wants to talk about it. But because it involves option trading and especially selling options, it has the stigma attached to typical option trades that like turn off people that are more risk averse, like people who are more into ETFs and long term investing. So it's in this awkward place where people believe like because you're touching options, you're doing some degenerate stuff, so people shy away from it.
And no, Tony, don't laugh at this. You should hear the call that me and Jack was previously. Um, it's I don't know. It really gave me a perspective. Okay, you know what? I am definitely winning here because people think of options as gambling, and it is if you use it wrong. But if you use it smartly, it's not really.
Yeah, so like basically I think you have the camp of people who are interested by options because of the potential lottery ticket appeal. It's cheap to get into and they see the potential for infinite gains, right? Realistically, that's not going to happen. But eventually they're going to come across people saying, hey, you're a dumbass, you're losing your money buying these calls. Go to the other side, like join Theta and start selling cover calls or whatever. And they're not gonna be as interested because it's not a lottery ticket. It's like Amir said, it's just a slightly faster way to make consistent income, right? But um, the reason that these people got into options trading was never to long term invest, right? It was to uh, get rich quick. So I think this strategy is more niche and less popular because it's precisely falls in the middle of these two camps. Like it seems too risky for your typical boomer investor, so to speak, right? But it also seems too safe for your
Michael would never
new-ish
do this.
degenerate. Yeah, exactly. Michael wouldn't even hear about it because it involves
Yeah,
the word option. But I think if you explain it to him, he
yeah.
would understand the appeal. And
Fuck, I'm in.
yeah,
Yeah.
and
Well,
also
not probably.
Amir's just the
Not fuck,
type
I'm in.
to play along with the whole degenerate. So like when we're in the call with the other people and they're like, Amir, what's the riskiest shit you done? He plays along with it. He's like, oh yeah, I lost $50,000 doing this. Like the things that he's doing some ridiculously risky and like dumb plays, but they don't understand the actual play here.
Yeah, I think once
Yeah.
you actually explained it and I understood it, I think fully. I don't know if I understand it fully, but I think I understand it fully. That yeah, I was like, okay, that it makes a lot of sense. Like, right, I'm not gonna say that that's super duper risky strategy because, like we were discussing, you're making money off of selling that option in the first place, right?
Yeah,
And
and it's like put it simple. It's like a guy like Michael will never touch options, and for somebody that does touch options, there's nobody that's going to be the Michael of the options because that's just not why they go into options. And
So
there's very selective,
Amir's the Michael of the options.
sort of speak, right? And I'm not saying there's no risk involved in this. There's definitely risk. Um, do I FOMO? Yeah, fuck yeah, I do. Fucking I FOMO all the time. But it's about controlling your emotions, and then I think whether you're trading options or not, and that's the most important thing of investments is just control your emotions, and that's why what works really is just passive investing. Put it into an index fund, and it works because it doesn't really fuck with your emotions, right?
I think
Time
yeah.
the market doesn't really work.
I think one of the reasons why passive investing works so well is because you're not given the opportunity to fuck your own investments up. Like,
Yeah, yeah.
if everybody could make money off active investing, then more people would do it, right? But chances are,
That's
if you're if you're playing around making your own bets or making your own plays, you're gonna, on average, end up performing worse than the overall market.
I think with the active traders, the way they're making money is by charging that fee.
it depends, right? If you're active, like if you're a hedge fund or something.
Oh, you mean like day trader courses? Is that what you're talking about?
No, sorry, I meant what Jack said. Like if you're a hedge fund, if you're a bank, or
Yeah,
something, right?
okay,
That's
He's
yeah,
talking
yeah.
about once you have enough money, you're collecting like 0. Whatever percent, but it's a
Right,
huge amount, right?
I got it.
But for
Yeah.
retail investors, if they're actively trading, it's usually because they have an irrational sense of confidence in their own ability to outperform the market. And people who do it maybe professionally, like who are active day traders and can make an income of it, they're actually good at finding these market inefficiencies and exploiting them.
My
And
intuition
I'm not
is
saying,
that
Yeah, we're
my
not those
intuition
people.
yeah, we're not. I am.
Yeah, my intuition is that the characteristic of the type of risk that Amir is taking on is very different from the type of risk that a usual options trader takes on.
And when we
Like
say
I think the
usual,
nature of the risk is
we're
different.
referring to like the 2020 new wave of like investors who are doing really short term, out of the money expiration date options, cheap contracts, potentially high returns, right? Because technically the usual way to use options is to hedge your existing investments. If you're over leveraged in a particular field, you're afraid of getting exposed if that industry tanks, you short or you buy puts on a percentage of that. So that way you're at least a little insured. I think that is the intended purpose of options, basically.
But yeah, that wraps it up. And I think really how I sees it currently. Well, man, I'm hella bullish on the market right now. So that's my strategy. I'm selling out with money calls every single day. I don't care, right? And
But
when this COVID ends,
if you're bullish, then
I'll stop most likely, and I'll be less aggressive of the selling and go enjoy the other things in life.
I think if you're bullish, wouldn't
That's
you
just
be
how.
afraid to sell calls? Because selling calls means it's an indicator that you're bearish. Selling calls implies.
I guess so. I guess so. But like the thing is, to think it another way is that I would never lose. The thing is, like if the
I
market
think
tanks,
you're
I
bullish.
could
You're
actually
bullish
lose.
on investors. Like you're bullish on the investors' like confidence in the market. Like you think they're bullish, so you're selling way more out of the money calls.
Well, I am bullish because I am okay with my stuff getting called away.
Okay.
Because what I really don't want is my stuff not getting called away. I'm stuck back holding it.
Yeah, I think I
Right.
get what you mean because the
that's
price you can charge for these options are higher, right? If the stocks are going up and the investors believe that it will go up, and then therefore they will pay a higher price for this call, right? And so you're making more money off the price of the call
Technically, you're not
when the
selling
market
price,
is bullish.
but it is kind of like that because the price of the call or the put is reflected in like what we talked about, IV before theta, right? There's a bunch of factors, but the main one that's going to drive the price is IV. So if more people are buying options, the price of that option increases. That benefits Amir. But he's not the one like inputting the sell price on Robinhood. It's like selling a share. It's like there's a market price that's determined in real time by the bid ask and whatever.
Yeah, that's what I thought because I thought you had to be like a registered market maker type of person to be able to create your own options, which clearly Amir is not.
that was pretty advanced, man. The market makers, dude. Those are the real tendy makers right there. Yeah. Unfortunately, we are not market makers. You're right. So we.
Like I said, I'm just taking that cherry. They can have everything else.
Yeah, he's taking the cherry on top.
That's my game plan. That's after March. I realized how crazy I was. I was like, okay, time to rethink about my strategy because this shit, I'm gonna burn hell if I keep doing this. Yeah.
But yeah.
Yeah. Anyway, so this has been a really informative session. I think this whole strategy Amir has is really cool, and now I'm thinking that there must be like tons more of these interesting strategies out there.
Oh, absolutely.
Unfortunately, I think I'm not
here's the thing.
interested in them enough.
The wheel is
Sorry,
one
go
of the
ahead.
most. wheel strategy is one of the simpler strategies. Oh God, there's some that I haven't even wrapped my head around. I'm like, what?
Honestly,
How?
if you're only buying like one call or put on a security, I would say it's a pretty simple strategy. Like most option strategies involve buying multiple like calls or puts so that you set it up in a way that you're making money if the price is going either way, or you can make money if the price is relatively still. Like there's you can inverse your play on IV and bet that it's going to be stable and still make profit off that. I think people who are into day trading, they're really attracted to like opportunity cost. They're like trying to maximize their potential gain at whenever possible. Whereas people who are into more long term investing are just betting on the overall sentiment of the market always being bullish in the long run. There's a difference for sure. But yeah, I think that's a good place to end it. I really like this whole format of like we had two really opposing takes on investing, and we had a nice back and forth, and I think we saw some pretty good points on both sides. Um, and I do think in the end of the day, it does really depend on the type of person you are, how you value your free time, how interested you're even into like this kind of investing in general, right? So there's no right answer, like you guys said. There's many paths to Rome, and as long as you're playing it smart and you're making gains, that's all that matters, right?
Yeah, absolutely. And I think with that, we'll end this episode.
Yeah, cool. Yeah, that was pretty good.
Cool.